Welcome to the Foundations of Investing, where we break down the difference between mutual funds and ETFs in a simple way. To kick off our comparison, let's look at the sheer scale of the landscape we are dealing with. Over 62 million American households rely on funds as the primary bedrock for building their long-term financial freedom. When we look at total assets under management, traditional mutual funds still hold the majority market share at $27 trillion, while ETFs currently sit at $13 trillion. However, that gap is closing rapidly as money continues to flow into the ETF structure. Visually, you can think of both options as baskets holding diversified collections of stocks, bonds, or other assets. They both solve the core problem of diversification. The real debate isn't about what is inside the basket, but rather how you buy it, what it costs you to hold it, and how it fits your personal trading style. Here we look at trading hours and liquidity. When it comes to buying and selling, these two vehicles operate on completely different rhythms. Exchange-traded funds live up to their name by trading continuously throughout normal market hours, from 9:30 a.m. to 4 p.m. If you place an order for an ETF, it executes instantly at the exact real-time market price, using a bid-ask spread. Mutual funds, on the other hand, trade just once a day. No matter what time you click buy during the day, your price is locked in at 4 p.m. based on the final net asset value, or NAV. This creates a fundamental trade-off between agility and discipline. ETFs give you immediate liquidity and real-time control. Conversely, the delayed settlement of mutual funds acts as a hands-off, panic-resistant buffer that stops you from making emotional impulse trades during volatile market swings. If there is one absolute rule in investing, it is that fees are the ultimate enemy of compound growth. Over a 30-year horizon, even a tiny fraction of a percent taken out in fees will slice away tens of thousands of dollars from your final wealth. When looking at the Morningstar averages, ETFs consistently hold the cost advantage across the board. Index ETFs average just 0.48% compared to 0.58% for index mutual funds, while active ETFs sit at 0.74% compared to 0.87% for active mutual funds. ETFs are structurally cheaper because the vast majority are passively managed, and they don't carry extra marketing or 12b-1 distribution fees. Active mutual funds require expensive research teams that drag down net performance. Shaving off just 0.25% in annual management fees preserves a massive portion of your portfolio for your future self. The barrier to entry is another area where the path diverges significantly. ETFs have essentially eliminated barriers to entry entirely. You can start investing with as little as $1, or simply the cost of a single share. And fractional share brokers make it accessible to anyone instantly. Mutual funds generally require a much steeper initial buy-in, often ranging between $500 and $5,000 just to open your initial position. However, mutual funds hold a distinct operational advantage once you clear that initial hurdle. They offer seamless, exact dollar, automated investing. You can easily set your account to buy exactly $100 worth of a mutual fund every payday without worrying about share prices or leftover cash balance, making long-term dollar-cost averaging completely frictionless. When we tally up the final score, the ETF takes the crown as the overall winner for standard brokerage accounts. Its combination of lower management fees, zero minimum barriers to entry, intraday trading control, and superior structural tax efficiency makes it the superior choice for building wealth independently. With that said, mutual funds are far from obsolete. They remain a phenomenal, unbeatable vehicle within employer-sponsored 401k plans, and for hands-off investors who demand strict, automated discipline without the psychological distraction of intraday price charts. Ultimately, your choice should come down to matching the vehicle to your specific account type and your emotional investing habits. Thanks for watching this video, and be sure to subscribe for more updates.